Last week, the IMF mentioned what's going on in Japan with regards to the yen and whether the Bank of Japan needs to intervene. But they secretly gave away the key to trading FX. We're going to have a look at what that was. And then are our heating bills going to be cheaper this winter? We're going to take a look at the nat gas market briefly and see whether there's some alleviation in the price versus the mayhem of last year. And the Trading Takeout today is going to be taking a look at Lehman Brothers' FX trading manual, which is always a very good read. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So yes, on October the 14th, which was 2 days ago, so I think Saturday, the IMF actually mentioned the situation with what's going on with Japan and the yen. And effectively, they've given the blueprint as to how to trade FX in the medium to long term. So the senior official said, on yen, our sense is that exchange rates are driven pretty much by fundamentals. I completely agree. As long as interest rate differentials remain, yen will continue to face pressure. Again, completely agreed. I've said it multiple times. You know, a lot of what we look at in FX might seem like it's to do with technicals, might seem like it's to do with, different things, but predominantly it's to do with the exchange rate differentials. And then the fundamentals off the back of that is then how are interest rates priced in the future relative to change in fundamentals? And that is what drives FX markets. 100% agreed with the IMF here. Tweaks to yield curve control Bank of Japan made in December last year, July this year, curve were very much step in right direction, gives BOJ flexibility to move in either direction as necessary. So what the Bank of Japan have been doing as part of their unconventional monetary policy was raising the yield curve control cap, slightly in response to inflation or inflationary pressures, I might say, where previously they'd had it at 0.1%, I believe. They'd risen it now to 0.25%. So it gives them a little bit more leeway to allow yields to rise a tiny bit. Once wage and price developments are such that it's clear inflation will durably stay at or above 2%, that will be the time the Bank of Japan could raise short-term rates. So again, absolutely agreed with the IMF for once. This is a fantastic and sort of underspoken about blueprint to trade in FX. And it's really, really quite astonishing. I actually commented on it on Twitter saying, this is literally how you trade FX. Will most people listen? Probably not. So if we want to re-simplify this, what you're doing with technicals is you're looking at key areas to do business at, whilst the direction of play should predominantly rest on these factors here: how interest rates are affected by a change in fundamentals, and to what extent they are affected. That differential is pretty much what drives the direction in FX. So last year, our heating bills were astronomically expensive. Well, in the UK, they were anyway. And there was a little nuance there with regards to the UK, where the government had stepped in and the energy price cap. So they actually tried to cap the price of energy. That was artificially keeping the price elevated because firms could pay up to the cap, when really the price and cost of hedging had reduced in about January, February, maybe March. So we were paying higher prices up until July into the summer, which was absolutely ridiculous. But the situation's looking a lot better this year. Now, in front of you, there is the nat gas forward curve. And what you can see is the price ticking up over the next couple of months into December, January. And that is very much seasonality, seasonality focused there. And you can see it happens every single winter. And this is the price all the way out to 2035, well, even longer actually, almost 2036. But basically what we're seeing here is the rise into when demand increases for nat gas because people have to heat their homes. Okay, it's very different to oil, where the demand for oil is actually shown to be subsiding. And we've spoken about that quite a lot recently. But with nat gas, there doesn't seem to be the same issues as last year, especially when we look into Q1. Okay, so Q1 seems to be their pricing for nice stability. You can see the prices decreasing here into March, where we're probably going to find the bottom, and then they start ramping it up again because they expect prices to increase for hedging into the winter. Excuse me. So I don't think we've got anything near the same issues, and I would expect for the UK for that price cap to keep coming down. I think the last reduction was last month. It's been quite heavily underreported, and the whole situation to do with the price cap and the price of energy in the UK has been very misunderstood. It's largely been a government intervention problem rather than a market problem. At the start, it was, of course, a market problem, lack of supply, etc. But they exacerbated the problem by saying, let's have this security, as the government loves to do, but they totally misunderstood the market. So it would have been more preferential for the market to have brought rates down as they did, rather than the government say, okay, let's keep the cap higher for longer. They just didn't understand, because the government never makes bets. The government always just wants certainty and stability, which you can understand from one perspective, but also it creates adverse outcomes, such as what we had when we have, energy being really, really high into July, which just doesn't make any sense. So yeah, big issues there. To do with government intervening in energy markets. I'm not a big fan. But in terms of the current pricing, we've had a spike over the last couple of sessions, really to do with the Israeli conflict. October 4th, you can see here, energy just went a bit bananas. That was likely to do with the potential for Qatar and other Middle Eastern nations to cut off supply. But as you can see here, we're reverting quite heavily now. It's a similar situation with oil. We saw oil spike up and it sold off a little bit. We're trading back a little bit higher now, but it's nothing crazy like what we were expecting. We did trade up to 95, which was certainly troubling for many people that I spoke to that are in the oil market. They started to think that, oh God, are we going to go for a runaway rally here? But it's contained for now, and it doesn't seem like there's any major escalation just yet in the region, which is fantastic. No one wants conflict. From a nat gas perspective, though, relatively orderly, just to show how mental things were last year. Let's unadjust that. This is where we were last year, and this is where we are now. Okay, so even if we see, a relatively large spike, even up to 2018, late 2018 levels, it's still not going to be anywhere near the same cost as last year. So do bear that in mind if you see any media reporting on nat gas increasing in price, because they're going to try and conflate it to last year. They know that it's an open flesh wound still, and the media is what it is. They report on markets and economic factors really, really poorly. So don't pay them any attention. But yes, there should be no real issues in the energy markets over the next couple of months, I would hope, unless, this is the if-then part of creating a thesis. If, anything kicks off, then energy could increase in price, but relatively orderly for now. Now, you might not want to take the advice of a bankrupt bank, but I've been through the whole of this document, and it really, really is fantastic. Now, this is the foreign exchange training manual that was given to all new FX recruits to Lehman Brothers. And it really is 130 pages of everything that you need to know to understand, what's going on in FX markets, how banks look at trading FX, or at least looked at trading FX before Dodd-Frank came in, because they were massive prop traders back then. Still are in some respects, but we'll ignore that. So basically, this is a guide for when banks were massive punters in the market. Okay, not so much now, but yeah, that's a topic for a different day. Now, what you tend to find here is that they go very much into options trading and very much into forwards, which are huge parts of the FX market. Obviously not so much as spot, because that's how currencies move, but it's all to do with hedging and things like that. But the thing is that hedging is such a massive component of FX that it can drive FX flows too. You need to understand, where people may be hedging, what the flows might look like. Not necessarily for a trading base, just to understand what your counterparties might be doing. But it gets into everything that you might need to know. So credit and settlement risks, for example. It gets into what market makers are doing, trading conventions among market makers. It gets down into funding. It gets down into what was Eurodollar futures, and still a very important part, but which is now secured overnight financing rate futures. It gets down into calculating swap points, for example, which is actually key for retail traders when you're holding positions overnight, because I think a lot of people get stung on the Wednesday swap, for example, because FX is settled T+2, changing to T+1, which should be a benefit. But yeah, it gets into like rules of thumb and things like this in swaps, and it gets into, as I said before, the option stuff. So really strong guide. All you have to do is Google Lehman Brothers FX training manual, and it will pop up. It's the first link. It should be under Stanford. It's uploaded to now, so it's on Stanford University's website. And yeah, it's definitely worth a read and an annotation and something to consume over time, I think.